Last weekend, I binged watched the cable series The Walking Dead. so I watched 16 episodes. Each episode is about 42 minutes long, and I watched 16 of them in about 2.5 days. Didn't get a lot of sleep, and since I binge watched The Walking Dead, and if you don't know what The Walking Dead is, it's this apocalyptic world is ending, zombies take over the world. And so after I binge watched that, still going on right now in my brain, like I have zombies in my brain. Like wherever I go for the past week, I've been thinking like, okay, if zombies started coming towards me in Whole Foods parking lot, how would I escape? And how would I get my kids? And who would I grab first? And when I'm at home with the kids riding around the block, on their bikes, I'm thinking, okay, are we too loud? Can the zombies hear us? And my brain's been hypnotically transformed a little bit to actually be concerned about something that's not even there. But because I spent 700 minutes over the past weekend with zombies on my mind, my brain is still looking out for them a week later. And I know consciously there's no zombies. But my brain doesn't, because it has just been put in front of a monitor for 700 minutes, and that's all it watched is zombies attacking humans. And so my brain has literally been manipulated to look out for something that's not there. Hey everybody, this is RC Peck, and this is my weekend podcast. And the theme of this weekend has a lot to do with what I did to my brain with all of that imprinting and images and words and sounds. And in the investment world, we have that happen to us too. And there's so much hype and information coming at us that's what I want to talk about with you this weekend in my weekend podcast, and look at two specific markets, the gold market and the S&P 500. So the theme, I'm titling the theme this weekend, Cut the Noise and Free Yourself. And one day I'll be free of thinking of zombies jumping over the fence. But this, in all honesty, this is a way to grow your portfolio, to free and secure your future, is to look at what noise is coming into your brain and eliminate that. And I think one of the best ways to do that is to look at price action. Maybe not only, but have 80% of what you're paying attention to is price action. So let me give you two examples. So the first example is just the S&P 500, the most followed index on the planet. If you look at the screen, you can clearly see that it is going higher. It's going from lower left to upper right. And there's a horizontal line, and that horizontal line is at the 1900 mark. So I'm not really concerned until it breaks below that 1900. I think it should come back to that and test it. Just emotionally, it looks like and feels like it needs to have a correction. No one calls me and asks me whether it should have a correction or not, but 1900 is a very solid number for the S&P to come back to. So this is one way for me to eliminate all the noise and simply say, hey, is the S&P at 1900? Has it broken through 1900? And I can eliminate all that other noise. Now there's another way I do this too, and I have a market strategy. I call it market probability. And what market probability does is just basically tell me if the S&P 500 is in yellow light mode or red light mode or green light mode. And if you look at the screen, I don't even have the price of the S&P 500 on the screen. All I have is two moving averages. And the two moving averages, when that faster one, the green one, drops below the slower one, the red one, I call that yellow light mode. And if you look on the screen going back 15 months, you can see the S&P jumps between green light and yellow light and green light and yellow light. And so right now the stock market is in yellow light mode. And right now I think the stock market, the index, the S&P, wants to come down and test that 1900. So I can look at these two pieces of information and eliminate an incredible amount of noise and just focus on, okay, we're in yellow light mode. It's time to be cautious. And the next major support is 1900. Now I have two more pieces of data that I just want to show you that I'm paying attention to. Now the screen here, it says stocks above the 40-day moving average. So this is the percentage of stocks in the stock market that is above their own personal 40-day simple moving average. And today, that means that there are 16% of the stocks that are above their 40-day moving average. Now, if you look back here, this August bottomed over here around 20, and you can see now in October, these new lows, or the percentage of stocks that are above or below their 40-day is actually lower. So there's fewer stocks above their 40-day than it was back in August. But if you notice right here, the price is above. So there's a discrepancy. So either more stocks need to move back above their 40-day moving average, or the S&P needs to move down. But this is just very simple information. And when I say simple, I mean powerful, that you can use to grow your money. I also look at the 200-day percentage. So this is the percentage of stocks above their 200-day moving average. And today there's about 34, almost 35% of stocks above their 200-day. Now, again, look back here in August. There was about 50%. When August bottomed, there's about 50% of stocks above their 200-day, and now there's only about 35%. So what this is telling us is the majority of stocks are below their 200 and below their 40. Again, not a lot of noise, just simple data, and this means, hey, something's got to give. Either the S&P needs to move down and test that 1900, or stocks, this indicator you're looking at right here, more stocks need to move above their 200-day. So basically, the takeaway is very large stocks are holding up very well. Apple, Microsoft, Google, they are holding up really well. They represent a very large percentage as market cap of the stock market. So the really big names are holding up really well. Even Walmart's holding up well. And that means people are looking more for secure places to put their money if they have to put it in the stock market. We're not getting crazy. We're not saying the sky's falling. We're simply saying, oh, okay, so people are taking their money out of the smaller stocks and they're keeping them in the larger stocks. That's good to know. When people do that, they have more concern about the future. That's all we're seeing right now. I, of course, will keep you updated if yellow light mode becomes red light mode or if anything else breaks down. But again, this is much calmer and simple. I want to say simpler, but I don't want you to think this is simple as in weak. It's actually simple as in strong. And this gives us those really great insights on what we need to be paying attention to. Okay, lastly, I want to talk about gold. Same thing. Gold's at a major support. Don't know why, but there's a lot of support. There's a lot of defending for gold at kind of the 1180-ish price. It happened back in June of last year. It happened twice in December of last year, and it just happened at the very beginning of October a couple of days ago. I don't care. It doesn't matter why 1180-ish is being defended. People are buying gold at 1180. The question is, can it stay at 1180? And for all of my subscribers, I put out an alert on what we should do at this current price. But again, we don't actually know what it's going to do tomorrow. We can only look at probability and really simple price action and have it say, okay, what are we looking at here? And that's what we do. Now, the other thing I thought was really interesting about gold is there's a company in Canada called Central Funds. And Central Funds, all they do, it's such a simple business model. All they do is they hold gold and they hold silver in a vault. And then they float shares that represent that gold and that silver. Well, today, literally, this is pretty crazy. I think this might be the deepest discount yet. Today, CEF, which is generally speaking half gold and half silver, is 9% below melt value. What its net asset value is, it's 9% below. On the screen, the greenish line is the price of CEF, and the orange line is the value of it. And this isn't value like what you think Google is valued at. This is literally what an ounce of gold and an ounce of silver are valued at. And CEF is selling for 9% below that. There may have been one lower read on this in the last 15 years, but I'm actually not even sure if that's true. 9% discount is pretty steep discount. And this CEF, when gold and silver was going up between 2000 to 2011, you could see a 9 or 10% premium on this. So literally, you're buying gold and silver at a discount to the price it is today. That is telling you how much out of favor gold and silver is. Again, simply cut the noise and just look at the price action. It makes things much easier. And if you're going to binge watch CNN or CNBC or anything like that, just know you're going to have great repercussions, including if you watch The Walking Dead. So the takeaway is you stop the noise by focusing more on actual price action. And you do that by looking at price charts. It cuts the noise, it calms your brain down, and you're able to have better returns with lower risk going forward. Hey guys, this is just really another step in helping you secure your future, your portfolio, and your life. Until next week, this is RC Peck.